US equities had another record year in 2021 as investors brushed aside concerns over the COVID-19 pandemic. Global markets followed Wall Street higher. The MSCI All Country World Index was up 33.5% between 2020 and 2021. The bullish sentiment was fueled by monetary easing from the world's central banks and fiscal stimulus from governments. The positive mood extended into the ETF markets, which were already experiencing robust growth before the pandemic.
To give you a little bit of context, global ETFs assets were around only 1 trillion 12 years ago in 2009. Assets doubled in every 3 or 4 years and reaching 8 trillion in 2020, and then to around 10 trillion at the end of last year, 2021.
In Singapore, ETFs also saw inflows, and their combined asset under management, or AUM, grew by 57% in 2020 and 47% last year.
For the suite of ETFs listed here in Singapore, growth momentum in 2021 is expected to continue in 2022. And that's on the back of a pretty strong listing pipeline that we've got coming in the next few months.
ETFs track an index, a sector or theme, or a commodity, and are a passive way to approach investments. Now, with economic growth slowing and inflation raising concerns of monetary tightening, have ETFs hit a speed bump?
There will be traditional sectors such as finance, oil and gas, which are likely to do well in a higher interest rate environment, while high growth stocks may not perform that well if the interest rate goes up further. So a well-diversified ETF would have a good exposure to all these sectors, and it will continue to go up higher because there are sectors that will perform in this new environment.
In this challenging economic environment, there have also been questions over whether an active investment approach will yield better returns. Unit trusts are generally actively managed and rely on the fund manager to pick the winners. These unit trusts aim to beat the market. That is, they aim to earn a return that is higher than the return of their chosen benchmark.
A lot of active managers get a bad name because statistically 70% underperform. But it's true that 30% still outperform. So if you pick a good fund manager and they manage risk well and invest well, then they can do better than the passive index return.
Passive investments, on the other hand, are benchmarked against a particular index and earn that index return.
Passive investing over the long term has done tremendously well. If we look at the most broad global equities index, it's the MSCI All Country World Index, the MSCI ACWI. That has returned double digits in the past several years. Over the past decade, it's returned almost 10%. Over long periods of time, maybe over 50 years, it would have generated over 7 to 8% annualized. And so if you compound the returns over time, it becomes hundreds of percent. So passive investing has definitely worked.
Regardless of the investment approach, investors will have to keep an eye on fees and costs. High growth is out and value is in. One value play is an ETF that tracks energy stocks.
A lot of these oil companies have not really expanded into new capex. Because of that, they're actually generating quite good cash flows. So it still could be a play for 2022, because I think when you look at it, as what I said before, capex has been low, energy demand is still relatively strong, so energy prices could still be heading up.
ETFs that track financial stocks will also continue to see inflows.
In a kind of a rising interest rate environment, as long as the yield curve kind of stays kind of like relatively steep, these kind of environments will be positive for financials as well. And also financials, if you look at it from a valuation standpoint, they haven't been in the very loved sector for the last few years.
However, higher interest rates will hurt ETFs which track bonds and REITs, or real estate investment trusts.
For bonds, the prices move opposite to interest rate. So if interest rate goes up, bond prices fall. And as for REITs, they borrow a lot of money to fund their property purchases, right? So higher interest rate would naturally mean higher cost of running their businesses, and resulting in lower profits.
You've got inflation protected bonds, those that kind of move up when interest rates or inflation go up. So there could be certain segments within the bond space where investors could actually position as well for these kind of macro headwinds.
ETFs linked to ESG, or environmental, social and governance factors, continued to remain in focus too after record inflows in 2020 and 2021. But investors have become more discerning about ESG investments. Valuations could become an issue.
As everybody jumps on the bandwagon, a number of these names gets pushed up in terms of their pricing. You have to have some sort of valuation discipline as well, because ultimately, it could get far too expensive for what they're actually delivering in terms of profits.
The availability of ESG data is another sticking point. To guide investors, SGX listcos must provide climate data in their sustainability reports from financial year 2022. SGX is also working on a data portal where investors can access ESG data. Ultimately, there are many ways investors can build up their ETF portfolios. They could pick a broad-based ETF that tracks an underlying index like the MSCI All-Country World Index. They could choose different thematic ETFs to build a well-diversified ETF portfolio. Or they could take a geographical approach by investing in single-country ETFs. There is no right or wrong answer, but they have to remember that they need to diversify.